episode of Talk Money with Me. It's a new series that we're trying out, and we have a very special guest for you today, Rob Carrick from the Globe and Mail. I'll introduce him in a moment. Just a few kind of housekeeping issues. You can tune into this. I don't know where you're tuning into it. We've got it streaming live on YouTube and Facebook and Twitter. We're going to have it available afterwards as well. So if you found some value in it, and I know you will with the guests that we have coming up, you can share it as well. We'll have that link up, and we'll have lots of resources for you today, and we'll let you know where you can find those links too. Also, I have Maroki Tong, my general manager, moderating. So if you're a little shy to ask some of your financial questions, and I know a lot of people are, a lot of people out there struggling, you can actually reach out and private message us. Probably the best way to do that is on Facebook. Just go to my page, send a private message. If you're a little too shy to ask a question during this series, that's all right. Or you can also go to info@kelleykeehn.com, and we will make sure that we get your question asked today. So without further ado, very special guest, Rob Carrick, personal finance columnist with the Globe and Mail. That's his technical title. I like to refer to him as the rock star of the financial industry. He has been a journalist since 1990 and just really an independent voice for all things finance. He's married with two 20-something-year-olds, and he's really trying to make sense of finance and bring it to you in an intelligent way with his 63,000 followers on YouTube or on Twitter. He's a popular gentleman for sure. He's had a number of successful books. His last one, which is so appropriate and germane to our topic today, is How to Not Move Back In with Your Parents, a young person's complete guide to financial empowerment. And Rob also has a new podcast out. It's fantastic. I really encourage you to check it out. There's a copy of his book. It's called Stress Test, and it's about the basics of personal finance for 20 and 30-somethings. Wouldn't we have all done better, Rob, if we had your advice in our 20s and 30s? And they just launched it on Tuesday. And you're going to find all of the links to Rob's book, to his podcast. He's got a really interesting new calculator when it comes to housing. You're going to find all of that as well at kelleykeehn.com/blog. Maroki just put that up. Thank you so much. So Rob, welcome. Thank you so much for being with us.
Glad to do it.
Yeah, you're in high demand. So before we get into, I really wanted to have you as the first guest because we've talked on a number of panels before. We've presented to a few boards and committees together. And I love how pre-COVID, you've always had really honest conversations about housing, about the potential shame of being a renter. We're going to get into all of that. Did homeowners or renters fare better? But first, just take us, let us know what's on the hearts and minds of Canadians. What are your readers reaching out to you about right now?
Well, that's an interesting question because if you'd asked me that question about 4 weeks ago and more, I would have said it was at panic level. People were questioning the very foundations of our financial system. Are my bank accounts safe? And so I would say, well, yes, because they're protected by Canada Deposit Insurance Corporation. And they would say, well, how safe is CDIC? It was like you couldn't reassure them. Everything seemed to be off the rails. And I'm finding now that the people who needed help have found whatever help is available to them. And the rest of the population is moving on to normal things. So my questions from readers have really started to segue back into basic things like what's the best credit card? What type of exchange traded funds should I be looking at? There are still a few people who are asking cautious questions. I want a safe place. A question I get often is, what is a safe place to invest my money that has a good return? I'll have to say, well, there isn't one really, but because that's the nature of safe investing. But so I would say things are moving back to a more normal level. And here's a little anecdote to illustrate that. I wrote a column for today's paper on some factors I thought that are weighing on the housing market, and it was one of the top stories on our website today. And I was thinking, people are thinking again about home ownership, and the pandemic's on, but they are going back to that old theme of how great homes are and how much home prices rise.
Yeah, and I saw that article today, Rob, and if we have time, I'd like to go through it because you had 5 numbers that you really want people to have in mind when it comes to evaluating if they should be buying a house. It was brilliant. You had 52 comments early this morning already. Who knows how many more comments you have already. So obviously, if you have a home and you were able to defer, this is one of the biggest kind of hot button issues that we have with our readers and followers is, did renters fare better than homeowners? You were able to defer your mortgage, skip a payment. They're going to roll that back in, let's say, at the end of your deferral. So you either have the same payment or maybe a slightly higher payment, have a little bit longer amortization. But renters didn't have that option.
Yeah, that's true. And that is, you know, renters tend to be a more financially precarious group as a whole. So you could argue, in a sense, maybe they needed their own help and they didn't get it. Although landlords were able to access some help, so maybe that could have trickled down. But so that's a fair question. But what I look at is the multiple costs of home ownership and how there was no relief for any of them. You know, you still had to pay all your big utility bills. You still have to worry about the upkeep of your home. There may have been some property tax deferrals available, you know, city to city. I don't know, but eventually you're going to have to pay those. The cities need the revenue. They're not going to let you off the hook. So although, you know, there's the marquee cost of home ownership and of accommodations, the rent or the mortgage, the renter says, I have my rent and then my responsibilities are done. The homeowner says, oh, I got to defer all my rent. I have property taxes, I have home insurance, I have utilities, I have my roof started leaking. You can't really defer that if it's serious enough. So I think top line, yes, maybe renters were a little more hard done by, but I think home ownership is a whole portfolio of different costs, and most of them have not gone away just because the banks deferred mortgage payments for 6 months.
You know what? That's a really valid and fair response. Yeah, that there's just so many more expenses that people aren't considering other than the mortgage. Now, when you and I were just kind of talking about this topic when we were just doing the tech run through, you were mentioning that renters actually, you know, have a lot of options. They could maybe move back with their parents, or they could, right? Sure. So talk to me a little bit about that.
Well, renters have a few escape routes. Now, they're not universally available, but students and young people, you could move back home, go back to your family home, go back to your bite out there for however many months until your salary resumes or you find a new job. You can find a roommate, have your costs. You can move to a cheaper location because rentals are the rental market is opening up a little bit and rents are falling. Maybe if you left your current place and moved to a new one, you could cut your rent by $200. The old, I see a place and I basically have to decide whether I want it on the spot kind of thing that's receding a little bit from what I can tell. And I have a little bit of a window on the Ottawa market because one of my boys had to move during the peak of the pandemic, and he found a place pretty quick and easy, and the rent was maybe a little affordable than it might have been previously. Another son happens to be looking for a place right now, and there's tons of places to look at, and that wasn't really the case before.
So do you think that that's the same in a Toronto, Vancouver kind of market?
I think it is. I mean, it may not be to the same extent, but, you know, people are losing income, and they're having to, if they can't pay their rent, they got to go. And so where are they going? There's all kinds of different places. But I think that's opening up the rental market. There's less, I mean, the real estate market has slowed down as well. So there are a few people buying up rental units to rent out, to use for Airbnb, and that's taking a little bit of a pressure off the market too. So I think there's by and large good news for renters who are fortunate enough to be employed now and can pay their rent. They have more options. There's less upward pressure on rents. And for those who can't pay their rent, I do think there are a couple of options to look at that the homeowner can't. I mean, you can't just say, I'm moving out of my house and that's that. I mean, you still owe your mortgage. You have to settle that up, and you need a place for you and your family to live. And most people will put every available cent towards the mortgage and let everything else go. And, you know, mortgage lenders know that.
Yeah. So let's pretend this wasn't COVID right now, and I was talking to you in February or January, and having that very quintessential Rob Carrick kind of conversation about renting versus buying. Right. And correct me if I'm wrong, but theoretically, it should be cheaper to rent. And then you take the savings that you would have attributed towards your home and use that for retirement. Is that a fair?
Absolutely. That's a perfect summary of it. And what am I talking about? The savings that the renter has over home ownership. There's the big property tax bill every month. There's the much, much bigger home insurance costs. And home insurance is becoming just a staggering expense. Every spring, I get so many complaint letters from someone today emailing me, my home insurance is going up 21%. Okay. So there's that. There's the higher utility bill, and then there's home maintenance / upkeep. The old rule of thumb is 1% of the value of your home on average per year. I think it's probably closer to 2% now. And then there's the discretionary improvements you make to your home because you own it and you love it, you want it to look great. Whereas the renter has much, much less scope to make that kind of expense. So it's all that savings that if you direct into an investment for the long term, and I'm not talking every living cent, I'm talking most of it, I think you could end up with a very sizable investment portfolio, liquid investments you can deploy as you want, whereas the homeowner has equity in their home, but it's not really that useful. If you want it, you have to borrow your own equity through a home equity line of credit, so the interest clock is ticking.
Yeah, that's a really valid point. How about the comments or criticism of people say that they've done the analysis and they feel that it really is pretty much on par, not that much more. And then there's also the forced savings element of the homeowner, where is the renter actually, are they taking that? What would you say to that?
I agree. There is a forced savings aspect to it, and nothing is forcing the renter to make that and to adopt that pretty aggressive and diligent investing plan. But homeownership is a forced savings, but it's also forced spending. People always overlook that. You've got to spend when you own a home. You've got to put a new roof on. You got to replace your driveway. You've got to shore up your basement if the foundation cracks. There are so many forced expenses when you own a home that people don't really acknowledge that. And you're pouring money into your house from the first time you move in to the time you move out. I mean, when you move out, you've got to make your house look its best, and that's when a lot of people are doing all these last minute little repairs. They need a handyman to come in and fix this, fix that. So yes, you know what, Kelly, I can make the numbers for housing and renting look any which way you want. Right. You want renting to look great? I'll make that presentation up. You want housing to win? I can do that too. I think they're both very valid, and I'm not placing a value judgment on either, but I do think I'd like to advocate a little more strenuously for renting because I think there's a prejudice against it, and it can work. Not for everybody, but it can work.
So let's talk about that. Let's talk about that stigma. And I've heard you talk before about the pressure of the baby boomer parents putting it on their kids that they're also they're piling on. So talk to us a little bit about that.
Well, in Canada, we place this value on home ownership that I don't think exists in many, many other countries, including the United States. They had sort of a home buying mania in the 2000s, but it got flushed out of the system with their big housing crisis in 08, 09. And I think, home ownership is still a universal aspiration in the US and Canada and elsewhere, but here in Canada, our minds have been sort of turned by this rally in house prices over the last dozen years. And we now think homeownership is a great lifestyle decision, which I will not dispute. For a lot of people it is, but it's also a home run investing decision. And you combine those two factors, and we just think there's nothing better one can do with their money than to buy a house. And no matter what happens with the house, no matter how bad your finances are, you will be redeemed by all the money you make over the years.
Yeah, absolutely. And I don't know about you if you crunch numbers, but for the last 15 years, I've been a personal finance educator. But for the 12 years previous to that, I was in the financial industry. And I worked with a lot of people that had apartment buildings and things of that sort. And they would look at taking out life insurance to cover the capital gains on the rental properties. So we would do an analysis of how much housing had increased. And I got to tell you, Rob, it was very little. It was very little. And I would go historically because you wouldn't want them to be overinsured, right? So you would project out. So it's really been this bubble. And the question of how long it'll continue, that's really interesting. What do you say? I'm sure you are aware that the Financial Consumer Agency of Canada a few years ago was warning Canadians to stop using their home as an ATM, just kind of switching from the renters and these readvanceable mortgages where you pay down your mortgage payment and then this line of credit magically has more available credit. What are your thoughts on that and how that might be leading Canadians down a bad path because they're forced savings over here, but then having this increased availability of a credit over there?
It's interesting you raise that because I more than once, several times, I've heard people say in the last while, oh, we paid off our mortgage quite a while ago. Of course, we have a home equity line of credit balance. And I'm thinking, well, then you got a mortgage. It's the same thing. You're borrowing against your house. You know, it's the cost of financing the house. It's the borrowing on the home equity line of credit. It's the same thing. I think people have just, before 08, 09, I can remember writing a story on the sudden interest in home equity lines of credit. They were really catching on. And then we had the crisis. And so that sort of smartened everybody up for like 5 minutes. And then housing started to go up. And everybody started thinking, wow, I remember these home equity line of credit things, and I see how much equity I'm making. I can just tap into more and more and more. And it's like this borrowing allowance I have, and it's getting bigger all the time. And people just thought, why wouldn't I dip into that? It's smart borrowing. The rates were pretty low, and it was so accessible. You go online, you go click, 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 and the money goes from your HELOC into your checking account. Bing, you got all this money, and you only have to pay the interest every month. It's very manageable. And some people sort of got used to seeing, okay, every month I pay X number of dollars to cover the interest on my HELOC, and someday down the line, I will pay off the balance, but I don't need to right now because it's very affordable to just carry it. And so HELOCs became, originally they might have been, how do I finance the renovation of my kitchen? I need like a year or two to pay that off. And they became, how do I finance my vacation at March break? And how do I pick up a new car because I just decided my old one's no good? Or how do I finance very short-term consumption-oriented things that don't add any value to my life? And we began to use them, as you were saying, as an ATM. I need cash. I will go to my HELOC, and the balance goes up a little bit. So what? So I'll pay a little bit more every month. And I think we became really reliant on them. Like I have seen surveys questioning people how much they're relying on their HELOCs, and there is a substantial number of people who are using those as like crack filler. Like I've got a little deficiency this week, dip into the HELOC.
Yeah, Pam just weighed in saying banks make HELOCs sexy. They do, don't they, Rob?
Not just sexy, but they make them like almost irresistible, because if you're getting a mortgage, you are going to get pounded by the mortgage person. Oh, you got to get a HELOC at the same time. Or if you're renewing your mortgage, you don't have a HELOC. I remember myself, go back about 15, 20 years. I thought, what do I need a HELOC for? I don't really see the need for it. And the bank just pounded me over and over and over. And finally, I guess we were doing a home rental of some sort, and I thought, I'll finally get one. And I'm glad I did. It's super useful. I haven't touched ours in years and years, not since the last home rental we did. But they worked on me, and finally I knuckled under and got one.
That's hilarious. I really want to touch on that one story that you were telling, because I hear this a lot too, where people are like, yeah, I'm mortgage free, but I've got this huge HELOC. And that because you do not have to make principal repayments on it, how much more trouble are Canadians potentially getting themselves into, because they've kind of pre-spent that equity, and I don't think they have a plan to really pay it down.
I think you're right. And I think eventually one has to pay what one owes unless you declare bankruptcy. So what is your plan for doing that? Is it going to be a bonus? Well, they're going to be scarce with the economy the way it is. Is it going to be a big raise or a career advancement? You know what? I don't prejudge anybody's job prospects, but I do know it's pretty dicey out there in the economy right now. I think the pandemic has really, forced us into a more real look at how affordable our lifestyle is, because this idea of pushing it forward and hoping rising prosperity takes care of everything. I mean, we're having like an interruption in that flow of things. And you know what? The prosperity increases we were seeing before the pandemic were not dramatically great. Like incomes have not risen very well. When you think about how the housing market's gone and the stock market's gone, wages have not done anything similar to that. They were starting to trend higher nicely in 19, but of course that's gone by the wayside now.
And do you think that it's people's fault? Like when you think that the number one rule of economics is incentives drive the market, and if you talk about FOMO and keeping up with the Joneses and the Instagram effect, but if we were in the 1980s and interest rates were at double digits, and where are we? I think your article says we're at for every dollar of disposable income we bring in, we owe $1.77 is the latest number. When I looked up the number in the 1980s, it was like 66 cents we owed for every dollar that we brought in. Like, how much are we really at fault when consumer spending is good for politicians, it's good for the economy, it's good for us in jobs, but it's not good for our personal finance? Like, and if it's not going to change anytime soon with interest rates, how do Canadians get their head around that?
Well, you know what? There's always some personal responsibility in all of this, but it's a very complex picture, and there is an interrelationship of factors that we've never had before. So in the 80s, we didn't have social media or the internet. So you think about all my exposure to ads and marketing and all the different channels out there that put it in my face. It's a different world now. Like if you have a phone and you're on it a lot, you're being marketed all the time. And then there's social media exposing you to the great lives that everybody is putting front and center on their social media. So we're seeing people at their best on their vacations, at their great meals out, gathering with their friends at the bar, at the concerts they're at, and we're thinking, that's normal. I should be doing stuff like that. And I think I do not in any way want to have fear of missing out underestimated as a factor in driving all of this. Our culture is based on consumerism. It really is. And I find that as time goes by, that trend gains momentum, and that is weighing on people. And I don't think we're like, I don't think we've developed the filters necessary to be a little more skeptical about that. We may, as we get more used to social media, and then we could give our kids more media awareness training, and helping them be more independent thinkers about this sort of thing. That may help. I don't know. I mean, they may be inventing new social media channels that will expand the range of opportunities to see other people doing cool things. I don't know. But I think there's definitely that. And then we have to remember the power of marketing by the financial industry. Look at how often the word dreams are used in selling mortgages and lines of credit and that sort of thing. They want you to buy this stuff. They're validating your choices with the marketing approach they're using. And they are aggressive in making sure that they can tick off HELOC on a list of products they sold Mr. and Mrs. Customer. And so, it's a complex world. Yes, these people are making the ultimate decision to pull the trigger on the spending they're doing, but they're being encouraged and incented to do it in many ways. And I don't think people fully understand how much influence, how much weight there is on us to be good little spenders.
Yeah, very good point. Rob, what do you think some of the biggest mistakes Canadians made coming into the crisis? And I think, the glaring one is the lack of emergency savings, which some generations have said they just have not earned enough to be able to even put that away. So maybe you can comment on that. And what are some other mistakes that you're hearing from people, or you think that people are probably like, oh, they wish they had done that pre-crisis?
Two mistakes. One, the emergency fund issue cannot be overstated in its importance. I mean, it was the most boring, nagging bit of personal finance before the pandemic. Have an emergency fund. People said, yeah. Since the last financial crisis in 08, 09, you never needed one. I mean, unless you were in Alberta. The energy industry there has been hit hard, and Albertans have really been up against it financially, so they would understand. But in many other parts of the country, you didn't really need one. Your investments were going up. Your house was rising in value. And you thought, if I needed money, I'll just go into my HELOC. So the pandemic comes along, and all of a sudden, people lost their jobs in a flash. And yes, they got mortgage deferrals, but they didn't get grocery spending deferrals, and they didn't get utility bill deferrals. Maybe they got some, but there's costs of living, and you need to have resources to cover them in an emergency. So we could talk all about these abstract emergencies that could happen, and people say, yeah. Now one's happened. it has shown clearly how you need to have a substantial amount of money sitting in a savings account. Who cares how much it's earning? It just needs to be there to cover off in case you lose your job. And I think the economy is going to be rocky for years to come. And I think there's going to be a certain precariousness in the economy. And I think having emergency savings is going to be a great savings for the mental health and the emotional health of people who are unfortunately affected by this economic precariousness. You're going to need it, quite possibly, so please have it. The other mistake is investing too aggressively. People saw the stock market turn in a great decade. There's a couple of losing years in the past decade, but if you look at the 10-year average annual return, a lot of, especially in the U.S. market, people just made crazy amounts of money. And I think they got a little complacent about the need to sort of have some bonds and diversification in their portfolio. And I saw this in action in late March, early April. These seniors were emailing me and saying, I think I'm going to run out of money. I'm going to, like it's like someone pulled the plug and my RIF is draining out. And they were petrified. And market stocks have come back a lot, so I think a lot of the anxiety levels have receded. But it showed me that people have not designed their retirement portfolios in a way that anticipated something really bad happening. They anticipated just endless stock market growth. So I think going back to basics, you need to have cash in your RIF to cover 2, 3, 4 years of expenses so that you can say, oh, my stocks are down, leave them be. You can cover your expenses for 4 years and let your stocks recover. And they will recover, but it could take time.
Yeah. Okay, I want to unpack two of those that you just said. So first, let's talk about the emergency savings account. Do you think that too many people, kind of like you said, thought, well, I could pull it out of my house if they needed to, or they actually had a line of credit, but maybe started to dip into it, or had credit cards and felt that that was, ticked the box. How important is it that they actually have physical cash? Like you said, don't mind if it's earning nothing. It's important that you actually have that.
Physical cash is what it's all about. I mean, when you are up against it, the reason why you're feeling stress is A, you've lost your income, but B, you can't pay what you owe. If we didn't owe any money, like just ask someone who's paid off their mortgage how much extra money they have. Having physical money allows you to address emergencies. I need money for this. It's there. What if you're on half hours and your car needs major repair and you need the car to get to your job? You need emergency funds. Debt is the problem, and if you're going to use debt to solve your emergencies, you've compounded the problem. So, I think it was like the executive solution to emergency investors. Oh, use my line of credit. But we now know that the line of credit is going to be drawn down probably to begin with, and your credit cards are going to have balances on it. What can I do to pay my expenses that isn't going to give me more of this debt that's already causing me stress and undermining my financial stability? And it used to be 3 to 6 months was the rule of thumb, and I kind of scoffed at that because that was so high, and I thought people are never going to have that much, especially people who are young and in the workforce. But I'm now seeing that that is a good goal to strive toward. And if you say, I could only do 1 month, I say, well, that's a lot better than 0 months. Yeah. And if you have a couple $100, that's a lot better than nothing. So start with what you can do and build up. Some people are going to have to pause their retirement saving to build up their emergency fund. I don't have a problem with doing that.
That's a very good point. What would you offer as advice or thoughts on people that have the high interest rate credit card debt, have the line of credit? Should they save on the side, pay down the debt half and half? I mean, there were some reports, and this happened in the U.S. mostly during the financial crisis. I was back and forth doing media, and people were getting their credit cards like slashed in half or reduced significantly or what have you. And Susie Orman was like, don't pay your credit card. Make sure you've got some cash on the side because you don't know if you're going to have that credit card or not. Now, that didn't happen at all in Canada, just a little bit. It's happened with the COVID crisis. What are your thoughts on that, Rob?
Well, people are obsessed about their credit scores now, and rightly so. There's so many facets of life that tie into it. Your credit score determines what interest rate you're going to get when you borrow. Employers are looking at them, landlords are looking at them, insurers are looking at them when they're setting your premium. So there's multiple applications there. But not paying your credit card will hurt your credit score in a while. That said, it might be worth taking a little pain on the credit score if so that you don't blow up your whole cash holdings. I don't think taking all your cash and putting it against your credit card bill is probably the right thing. Credit scores can heal over time, and more to the point, you can make arrangements with your credit card company. They're offering deferrals on credit card payments now too. Maybe you can negotiate a lower rate. Maybe you can negotiate a credit plan. That can be addressed, but zero cash and zero savings, that's really hard to deal with. So I think preserving cash is super important.
Yeah, it's kind of going back to what our grandparents told us, right? Or our parents told us, but really hearing that. Yeah, so important. Now, the other one that you talked about maybe taking on too much risk and things of that sort, do you feel that people really got a sense of maybe, because this was so significant compared to even 2008, 2009. Do you feel that there's a lot of investors, especially older investors, that don't really understand their risk tolerance and their appetite for risk and volatility, the huge swings up and down until it happens, and then make bad moves?
Totally. Yeah, there's no question that's true. You ask people, what's your risk tolerance? How much of a decline could you stand in your portfolio? Is it 25 or 30 or 10 or 15? They'll often go, well, I don't know, I'll pick a number. And then when it actually happens, they're like sick to their stomachs with worry. I don't think people, generally speaking, can accurately assess their risk tolerance unless they have lived through one or two market crashes. And even then, as time goes by and the trauma starts to recede in their memories, they start to lose perspective on it. Also, interest rates are super low. So if you say, I'm going to put some bonds in my portfolio, people go, I'm only getting 1% of my bonds or 0.5%. That's dumb. That's stupid. I wouldn't do that. I can get 3.5% dividend yield on a stock. Yeah, but that dividend stock might go down 30% in value, and that's going to scare you badly. And your bonds, they fluctuate a little bit, but they're not going down that much. I mean, I think, you know what, it's hard to tell people that the diversified portfolio is going to make less than if you had all stocks. It's going to. But when the times turn against you and the stock market crashes, you're going to be in way better shape. And that is when you're going to be feeling the anxiety and the stress the most. And you're going to be so glad you did it. So you have to sacrifice some upside in order not to get mauled on the downside. And I think people are understanding that now. And I think for a couple of years, we're going to see some very conservative investing trends. A lot of money is going into savings accounts now rather than investment products. And I bet that will continue for a while. But I know that when we start getting economic numbers saying, no, the pandemic is over and out, done, things are really looking up and stocks are taking off again, people are going to get caught in the same pattern of overestimating how much risk they should have.
Yeah, that's such a good point. If we can just kind of shift a little bit back to housing and your article, actually, before we do, we've got a question here from Josie. Thank you so much. Do you still believe that a 60-40% portfolio is the way to go, or do you think that alternatives need to be part of one's asset allocation? That's a great question.
Really good question. It's so topical because I have seen alternative investments being marketed like crazy, like mutual fund companies are issuing them and advisors are talking about them. Now, alternatives are basically investing in things that are not stocks and bonds, on the idea that when all hell's breaking loose in financial markets and the stocks and bonds are all going haywire, that if you invest in commodities or real property or private equity, that's sort of shares in companies that aren't publicly traded, that you will have these insulated assets. And I think alternative investments have done reasonably well in the pandemic, but that's not a good enough argument for me to use them. I don't think they're necessary. And I know there's advisors who'll be waving their finger at me going, tisk, tisk, Rob, you don't get it. I think a 60-40 as a starting point for your portfolio is just fine. You want to have some corporate bonds, government bonds. You want stocks from Canada, the United States, and internationally. You can fine tune the exact mixture. That is a good, durable, year in, year out portfolio. Alternatives are a fad. I saw them have a previous period of popularity around the time of the last market downturn. I didn't hear a word about them for 10 years because they basically didn't do anything worthwhile. And now they're having a heyday again. You tell me they've done really well since the pandemic. Okay, get back to me in a year or 2 years or 3 years. And if you have a good average annual return, I will entertain them as a possibility. They're super expensive. They're hard to understand. I don't think even a lot of advisors understand them. I don't think you need them.
That's a really great response, Robin. Don't you think too? People like want some kind of action when the stock market is volatile. It's like give some solution of something to do, and sometimes people are.
You're so right about that. One of the weird trends that we're seeing right now is this day trading craze. Because stocks went down like a mile a minute and then they popped right back up again. There's a lot of young investors who've been using free trading apps, and they hit the jackpot. Everything they've touched is like doubled and tripled, and they've made a lot of money. And these trading apps have become like, it reminds me of tech stock trading back in 1999, 2000. Everybody was doing it. They weren't doing it with apps. They were doing it with online brokerage accounts. Everybody thought, I'm a genius. Who knew that I could be a day trader? And what happened was the market shifted and it wiped them out. And it took like 10 years for day trading to even be a phrase that you heard again. So it's happening again. And I think that people want action and they're getting it. Stocks just came on like a locomotive after they hit their low in March, early April. I think people are being faked out again. I think the market will take them to school. It could happen this year, it could happen next. I don't know, but there's no way investing is this easy, and there's no way the action is that rewarding. Investing is super hard, and I think the market will remind everybody of that in due course.
It's really that investing versus gambling, right? I too have heard the many stories of people that made it very, rich for a short period of time, and it's knowing when to cash out at the casino, and no one ever does. That's why the house always wins, right?
Exactly. Investing is 10 years plus to me. I'm putting money in stocks and bonds in a mix, and I won't really need to worry about that money for at least 10 years. And I know over 10 years that most stock market downs and ups will average out, and I'll have a nice average annual gain. I'm going to go out there and say, diversified portfolio, 60-40, stocks, bonds. Maybe you get 5-6% on an average annual basis. And I think that's a pretty good outcome. The world, as it's going to play out over the next several years, is not going to be a high growth, place to make a ton of money. I think interest rates are going to be super low. We're going to be trying to sort of build back to where we were in January 2019, when things look pretty good across the world. Yeah.
So Josie's saying she's taking it that you're not a big fan of liquid alts then?
No, I'm not.
Yeah. And didn't I read somewhere that like they have MERs like as high as 8-9%?
Well, it could be there are performance fees. When I hear an MER, that's like off the wall, but it could mean that performance fees are affecting that. And performance fees are okay if usually they kick in after there's a certain threshold of great performance. I just don't think they're necessary. I'm not sold that this is a portfolio building block. I think it's the investment industry trying to sell things to people who think, I don't know about stocks and bonds. What else you got?
Yeah. And the advisors are scared too, right? They don't know. They don't necessarily know how to quell the fears of their clients. And people think that doing something is better than just doing nothing. Like, why aren't you doing something? It's not surgery. Right. It's a long-term game.
For sure. It's super hard to be an advisor these days because you tell people these basic principles, but sometimes these principles are tested. And it takes a while for us to see what that was the right thing to do. So in early April, all the advisors out there looked terrible because their clients were getting massacred. Even conservative balanced portfolios were down. But now at here we are at June the 18th, and the diversified approach looks pretty good. You know what? Stocks came right back, bonds righted themselves and started doing okay. And nothing I've seen in the aggregate over the past 4 months has made me think we have to question all the basic fundamentals. I'm sold that those are still right.
Yeah. So pivoting back to housing, you know that the mortgage rules are tightening in July. I want to know your thoughts on that. And also a lot of people think that this is maybe a great buying opportunity, or they just absolutely want home ownership. How do they save for that down payment? What's the best way to get in if they've really done the analysis versus rent versus buy? And what do you think of the mortgage rules? I know there's a little bit in that.
I'm in favor of the mortgage rules. I mean, my job isn't to sell houses and write mortgages, so I can look at it analytically. And I think making the requirements for handling mortgage payments a little more stringent if I was writing the rules, that's what I would do. It's good personal finance. It's not, I don't know if it's good for selling homes, but it's good personal finance. It's saying I need to be a little more solid financially to get a mortgage, to qualify. And we're talking here about mortgages when you don't have a 20% down payment. You need to get mortgage default insurance. I'm all for it. And yes, it may slow down the market, but again, the greater good is served by having people buy homes and have it be a good financial fit. And it's a big win. You get the long-term price appreciation, you get the joy of raising a family in your house, and you get that feeling that I got this. I can pay my mortgage and keep my house up and take a vacation and save more for my kids' RESP and save for retirement, and it's all working out. It's not that I have to use my line of credit to go on vacation because there's no money left.
So, Rob, I serve on a number of financial literacy committees and you've spoken to a lot of those financial literacy committees. What do you think about, nudges? Like we have CPP, which is a forced savings to help Canadians make sure that they've got money at retirement. What's like crazy ideas? Like what if, with a new mortgage, there was like a forced emergency savings element that actually took a portion of that payment and put it into an emergency savings? Like, what are your thoughts of the government actually forcing financial institutions to like you could still opt out, but actually setting these mechanisms up that make it easier for Canadians to protect themselves?
2 words, thumbs up. I think it's a great idea. I remember when I first started working, maybe you'll remember this, remember Canada Savings Bonds and the payroll savings plan they had? Basically, your HR department would take a little bit of money off your paycheck all year, and at the end of the year, they would send you an envelope, and in it would be a Canada Savings Bond for $500, $1,000, $2,000, whatever. That was a great forced savings plan that people did, and they opted in, and it was very popular. Now, Canada Savings Bonds are faded out because interest rates were so low, but we never really replaced them with this sort of savings program for the people. And I challenged the HR departments of the nation, and maybe the CPP could look at promoting this in some way. Yes, you're going to give me $100 for your CPP and maybe $100 for your company pension plan. Could we take another 10 and put it in this emergency savings account? And maybe if we got a huge block of business, we could go to a bank and say, what premium interest rate could you give us for the participants in this, given that we're going to be giving you a large and growing block of money? I think nudge economics, as they call it, giving people sort of an encouragement to do smart things with their money is a great option. I'm all for it. And it has to be handled delicately because people don't want to feel like they're being railroaded into doing things. Opt-out should be easy, but not too easy.
Right. Yeah, very good point. Okay, so I want to get to your article because it was absolutely brilliant. So you've got 5 stats that you want us to know about. The first one is the 177 that we just touched on a little bit earlier.
Yeah, so what I basically did is I've been doing a lot of writing about the financial stresses people have been undergoing in the pandemic. And I get a lot of reports and surveys and analysis, and I started seeing all these factoid popping up, these numbers sort of showing how much financial stress was out there. And I thought, people think the housing market's going to take off again, and there's all this financial stress out there. And I thought, that doesn't really add up to me. So I basically, if you read today's column, I found 5 figures that I thought sort of exemplify the financial stress people are feeling. One of them was like the 42.1% unemployment rate among young people who are in university. Another one was basically saying that there's only about 5.8 million Canadians who are Canadian adults who are financially resilient. They can handle what basically just happened with ease. And the rest are either borderline resilient or not resilient at all. And I thought, well, if we're in that position, there's not a huge pool of people who can jump into housing and start driving prices higher. And I know after the last recession, basically the housing market here took off like a slingshot. Interest rates got chopped and prices just marched higher in a lot of cities, not all of them, but a lot of cities. And I know there's this salivating for the housing market to open up and let's see what happens. Let's see if it gets back to where it was. And it is a little bit in the Toronto market. Like I'm hearing a lot of stories about bidding wars and houses getting snapped up, but I just wonder if that is the last remnants of the speculative mindset working its way through the system. And as we realize that the economy is not going to snap back to where it was, and there's a general sense of a lot of people have been hit pretty hard by this, and a lot of people are kind of worried about their finances, even if they haven't been hit, whether that supports a big, rally for housing. I don't know, but I'm skeptical. I think housing could have a retrenchment. I'm not predicting a correction or a crash. I don't really know, but it wouldn't surprise me to see a sideways or a down market for a while. If I was a young person with good finances, I would be looking at this as a time to get in for sure. But you have to be confident about your job prospects.
Yeah, absolutely. Okay, so that just flew by 45 minutes, Rob. I'm going to check in with Muroki Tong, who's been kind of monitoring the questions coming in, the private ones as well. Muroki, do you have a few more? Hello, Muroki. You're muted. Yeah, that's all right. Okay. We still gotta love new technology. Okay. No.
Well, I was working on a podcast with me in Ottawa and people in Toronto. Believe me, we have seen every technical challenge under the sun, so I totally sympathize here.
Yeah. Yeah, absolutely. Well, I know we do have a number of questions. It doesn't look like we're going to get Muroki's sound back, but Rob, most of the questions I asked you were questions that we got from people that have been following this fascinating chat and promoting it coming up. So really appreciate you being our first guest on Talk Money with me. I admire your journalism so greatly because, especially in the world of personal finance, there are a lot of, we do have some questions coming now, but I'll just finish that. There are a lot of, great bloggers out there, great information out there, but there's also a lot of information that you don't know who's steering it and who's promoting what these days. So I think it's so important that now more than ever, we look to credible sources like yourself, the Globe and Mail, traditional media, and put that support behind getting subscriptions like I have to the Globe and actually putting your money where your mouth is so journalism like you can continue. And I got to tell you, I really appreciate it. That's why I often refer to you as a rock star. So let's get, if you've got a couple more minutes to stay with us, Rob, we've got some questions here. So Andrea says, in these unprecedented times, how vital is it for Canadians to review their finances with a financial planner? And I was actually going to ask you that too, like if we can talk about certified financial planners, qualified financial planners, if you want to, because you are a CFP as well, are you not?
No, I'm not. I have the Canadian Securities
Designation.
Nothing to do with financial planning. It's just it's an entry-level investment industry accreditation, which I took years and years ago. CFP, certified financial planner, RFP, registered financial planner. These are all, look for those. I think it is go time for financial planners. I think there has never been a period of time that can illustrate and reinforce the good they can do. Like the planners who told their clients, have an emergency fund. What happens if you have a period where you're not making any income? Let's check your investments. What mix do you have? What's your goal? When do you want to retire? The people who have a financial plan and a good planner are ahead of the curve. Now, the problem is connecting people to planners. It's a problem, and I'm not really sure what the solution is. A lot of planners only work with high net worth people. There's a growing cohort, work with all kinds of people. They charge by the hour, and they charge flat rates, and they are willing to sort of adjust the type of consultation they provide according to their budget. I would love to see those people highlighted more so that they can reach more people and help them out of their financial problems.